All right, hello everybody. This is Paul Rabelais again. Welcome to another one of my editions of Estate Planning Live. A little bit of a change of pace here. Normally I do it from my estate planning studio, also known as my home, but I'm traveling. I'm in a different location, so you're getting a different look today. All right, so the deal is topic for today, plan ahead for the looming estate tax. A few housekeeping items. All you channel subscribers, you're welcome to contribute to the chat, ask your questions, make your comments. Keep those chat questions positive, and just realize that I'm not giving anybody one-on-one legal advice. No attorney-client relationship is being established through this YouTube Live. Okay, so with that being said, we already have a question from the get-go. I have an individual brokerage account and usufruct account from spouse. Can I sell the usufruct stocks, put proceeds in my account so kids can get the step up when I pass, naked owners of my kids? That is a very intelligent question, Claire. It's really a Louisiana-oriented question because Louisiana has a form of ownership called usufruct. But yeah, you're onto something there. If you have the usufruct of stock and you sell that stock, you may incur some capital gains at that point. But you'll then have the usufruct of cash or a consumable. You become the owner of that cash with the obligation to account to the naked owners when you pass away for the amount of cash that you had at the existence of the time that you converted that stock into cash. And then if you purchase stock with that cash, you own that stock, still have the obligation to account to the beneficiaries for the cash. But yeah, you'd get that step up in basis that would avoid capital gains tax on appreciation from the time that that you purchased that stock after selling the usufruct stock. Okay, a lot of usufruct there. If you really want to be familiar with that, you can watch the recording later. But really an intelligent question. Hey, from Wisconsin, Cheesehead. What do you know? A Cheesehead from Wisconsin. And hey, Stephen from Texas. Okay, so today's topic is an important one. It's a not very much discussed topic, just because people tend to think of in the here and the now. Hey, Sherry from Vegas. But the deal is, and look, not every single estate planning live, not every video I make will be applicable to every American across the 50 states. Sometimes I address some of these topics that affect the more high net worth type people. So this one really, who knows what you'll wind up owning. If you're a saver, you're going to wind up with a lot. And hey, Texas lady again. But this really, in my mind, this is like if you have that $3, $4, $5 million estate or higher, you may want to pay some close attention to this video, because here's the deal. The federal estate tax, as of right now, affects very few people. If somebody passes away in the year 2022 and they had not made any large gifts during their lifetime, gifts in excess of the $16,000 or whatever it was at the time that the gift was made, annual exclusion amount, then that estate only pays federal estate tax, the 40% federal estate tax, if their estate exceeds $12.06 million in fair market value. Very few people will pass away, relatively speaking, in 2022 in America with an estate that exceeds $12.06 million. So everybody's like, estate tax? What's the rule? Nah, forget about it. Let's go on to dealing with income tax and capital gains tax and all this other stuff. But there's some changes coming up. And sometimes there's changes that might happen. A lot of people think the tax situation is going to get a lot worse before it gets better. And then there's the tax changes that are going to happen even if Congress does nothing. So there is going to be a change coming up effective January 1, 2026. So for people who pass away on or after January 1, 2026, and I'm guessing if you're listening to this video, you're probably going to be alive January 1st, 2026. But that's when our estate tax exemption, I'm going to say, gets cut in half. There's some inflation adjustment stuff that we have to factor into it. But let's call it, let's say in 2025, there's a $13 million exemption because it goes up every year. Automatically, even if no new laws are passed, that gets cut in half. It'll be about $6.5 million. based on the inflation adjustments for people who pass away January 1, 2026 and beyond. And here's the deal. If you're sitting on right now in 2022, a $4 million estate, and maybe you're still working, maybe you're investing, you're likely to pass away with an estate that exceeds $6 million as long as you live for a few years. All right. In addition to this potential tax problem that I'm going to address, what are some of the solutions that you should be considering now? People also worry about, well, what if there's these lawyer billboards all the way down the highway? People sue people for nothing these days. What if I get sued and or my assets protected in any way? So we'll address that. Some people say, estate tax is great, but I pay too much income tax now. Is there any way to reduce the income tax that me or my family may have to pay in the future? And then in addition, the problem, if you call it a problem with estate planning is you work your whole lifetime, you like to keep that control over everything that you have for your lifetime, and then it just all gets dumped into your heir's lap at once when you pass away. Two problems with that. One, it all gets dumped into their laps and it may get mismanaged. And number two, you don't get to enjoy, if that's the right term, maybe seeing your children benefit from a little slice of their inheritance that you may allow them to have during your lifetime, because you'd like to see them benefit from that. So those are all those kind of concepts out there. Let's see. Hey, New York City, like the Statue of Liberty, Vivian and Kim, thank you for your time. So what I do is I get focused and I deliver some material every once in a while. I'll take a break, see what's going on in the chat, and then I come right back. That's the beauty of estate planning live, is we get to have some of that feedback in real time. Okay, so now let's look at some math before I get to the solution here. The way the math works, I like to explain it in terms of saving for retirement. Pretty much everybody gets that, compounding rates of return do incredible things for you if you start your retirement income planning early. So for example, let's say someone saves, sets aside $2,000 every month, and they do that for 40 years. You could do some math pretty quick and realize that they have set aside, over those 40-year period of $2,000 a month, they've set aside $960,000. That's a lot of money. And then, however, if you do the kind of compounding math, and those funds, as they're set aside at $2,000 per month, if they're invested at, let's say, an 8% rate of return, 40 years later, even though they will have set aside $960,000, they will have a pool of funds worth $7 million. So everybody pretty much gets that compounding rate of return. Start to plan for retirement early so you can take advantage of time. I'm going to use a similar concept for purposes of estate tax avoidance and keeping more of what you have in the family. So now let's take that concept and apply it to someone who maybe they're like at my age, maybe they're 57 like me. And let's say this hypothetical person has, let's call it a $5 million estate, and it's invested, and maybe they're still working, and maybe they're not spending any of that $5 million, and maybe they're frugal like me. And they feel like they're okay. They're not going to run out of money. So they're sitting on that $5 million at 57 years old, and it's being invested. And let's say they're not really swinging for the fences, but they're investing it, and it enjoys a 6% rate of return. Well, somebody starts with $5 million at age 57 or at any age, then 20 years later, if that investment portfolio grows at a 6% rate of return, 20 years later, when that hypothetical 57-year-old person is 77, they'll have I have it here, a $16 million estate. Problem is that $16 million or a large portion of it, is going to be taxed at that 40% estate tax when they die, depending upon what the tax rate is and depending upon what the exemption amount is 20 years later. Nobody knows what that exemption amount is going to be in the future. What we do know is it's going to be cut in half in 2026. And quite frankly, we know that Congress and the president can pass any laws anytime. Sometimes people think I know what they're going to do, but I don't. But if I know it, you'll know it. So no one can accurately predict what this estate tax exemption will be. It could go from one extreme where the government eliminates the estate tax, and it could go to the other extreme where, like it was many years ago, there was a $600,000 exemption and there was a 55% top estate tax rate. And it can go anywhere in between. All we can deal with is what we can deal with. But here's the idea. Take that individual who is 57, has a $5 million estate. It grows at 6% per year. It's $16 million 20 years later, all subject to the estate tax, less the exemption amount. And let's say they thought to them, and let's say there was a $6 million exemption when that now 57, 20 years to be 77-year-old dies with a $16 million estate, $6 million exemption, $10 million subject to a 40% tax. That's $4 million of tax. So as soon as that person dies, the family's got to write a check to the IRS for $4 million. So let's say that same individual is telling themselves, you know what? I know I'm not going to need all of that money to live off of for the rest of my lifetime. I'm frugal. I don't spend much. I'm going to get Social Security. I might have some other income. And let's say that person's also saying to themselves, I hate paying taxes. The government has been taking taxes from me my entire lifetime. I want to pay my family to pay as little tax as possible. So what that individual or that couple, if it's a couple, does is they start realizing that they can start shifting assets out of their estate every year if they want to, at their option, so that when they pass away at age 77 or whenever that is, those assets that they've taken out of their estate, and to the extent those assets have grown over time, all of that pool of money completely avoids the 40% tax. And that individual, and if they're married, their spouse, still has their full estate tax exemption to shield what's in the estate. All right. Sorry, I'm in the low amount, not the high. Yeah, a man can dream, Stephen. Can a Medicare trust have the same tax ID? I'm so focused on this tax stuff. I think what you're talking about is Medicaid, not Medicare, interest, equity, loan, tax deductible. The interest misspelled is throwing me off. I don't know if you're talking about a HELOC or what, but let's go back to it. Okay. So what that individual or that couple does in their mind, they're thinking, I don't want to pay tax. I want money protected from lawsuits. I want to reduce my family's income tax burden. And what that individual who's maybe 57 is thinking, boy, my money's invested, and why do I want to aggressively invest it when it's just 40% of it's going to go to the government when I pass away? So that individual is thinking, you know what? I don't need $5 million. I can transfer $16,000. That's the 2022 present interest annual exclusion. More on those 4 words in a minute, present interest annual exclusion. I can transfer that to anybody I want to, as many people as I want to. I could transfer it to kids, grandkids, others. But let's say this individual and his spouse, they have 3 kids. He's thinking, you know what? I've got $5 million. It grows at 6% per year. $5 million times 6%. That's $300,000 of growth every year. My spouse and I, we've got 3 kids. Each of my spouse and I can give $16,000 to each of our kids every year. Let's start building up a pool of our estate outside of our taxable estate so we can transfer $96,000 out of our estate every year if we want to. Make sure that money gets invested. And if we do that every year, then 20 years from now, we won't have $16 million in our estate. We'll have $11 million in our estate and $5 million out of our estate. And if the exemption is $6 million between my spouse and I each having an exemption, that exempts 12 million from tax. We'll only have 11 million in our estate. So now we passed away. There's $16 million. There's zero estate tax because 5 million was out of the estate. They used gifting from early on and the compounding growth to get that 5 million out of the estate, preserving their exemptions, which were 6 million apiece when they died. They had 11 million. Thus, all of that 11 million passes free of estate tax as well. So that was the way that that couple was able to transfer $16 million to their family free of the 40% estate tax. Few more important points. Let me, I got so much I want to share with you. I don't know what to prioritize. That addresses the how to avoid estate tax. How do we address the, how does our family avoid kind of, if we get sued? Because if I have $11 million or $16 million in my estate and I get into a bad car wreck, and sure, I've got some automobile liability insurance, I've got some umbrella insurance, but what if somebody gets a $20 million judgment against me? My insurance doesn't cover all of that. They'll take my $16 million. So by shifting some of this money out of the estate, it's not in your estate anymore, and no creditor of yours can take that. And then we'll talk in a minute about how the creditors of your children can't take it either. Hey from Dallas, Linda, and hey from Tennessee, Lynn. I got Linda and Lynn both contributing at the same time. All right. What is the proper way to give a gift of inheritance for tax purposes? Can it pay directly to a debtor via PayPal? Good question. Let me address that in a second. Hey, David from North Carolina. All right. So the money that are the assets that are out of your estate, they're not subject to your creditors. If they're put into, I'm going to go ahead and call it now a Crummey trust. I'm going to get to that in a second. If it's put in a Crummey trust, it's not only exempt from your creditors, it's exempt from your children's creditors. If you put it in trust for your children and they get divorced, it's, they get to keep their trust, and your child and their spouse will split other assets that they have. And to the extent your children are income beneficiaries of that trust, if those assets produce income, and if they're in a lower income tax bracket than you are, there'll be less income tax paid because your children will pay tax on the income rather than you paying tax on the income that those assets produce. Okay, so where we're at so far is 47-year-old, 57-year-old, 67-year-old says, you know what, I've got about $5 million. I'm scared the estate tax is going to eat a big chunk of it when I pass away, because those people in Congress are likely going to increase the estate tax by reducing the exemption. And plus my stuff is going to grow. I'm a decent investor. I've got good help. It's going to grow over the next 20 or 30 years. So what I'm going to do is I'm not going to wait until they change the estate tax laws, because if you wait until 2026, then you're going to be sitting on a $6 million estate that grows at maybe $300,000 or $400,000 per year. You're not going to be able to give it away fast enough. It's just going to keep growing and growing and growing. The thought is start now, or at least consider starting now, and starting early. That way you'll take effect of that long-term compounding growth and be able to get more out of the estate. Now, key question, when you transfer it out of your estate, where do you transfer it to? A lot of people don't like the idea, and quite frankly, I don't blame them, don't like the idea of just transferring assets to their children. Sometimes bad things happen when you transfer assets to your children. They might spend it. They might get sued. Their spouse might influence them to do something with it. They might sell all the investments. Whatever, bad things can happen. So in order to get more protections out of those gifts, more likelihood that it's going to stay there, it's not going to go anywhere, you're going to be able to take advantage of the long time compounding growth. Instead of just giving it to your children outright, what you do is you put it in, here's the term, Crummey trusts again. On Thursday, I'm going to give the whole session on what is a Crummey trust, start to finish. But I'll mention 2 points about it right now. Number one is if you put it in a trust for them instead of just giving it to your children directly, then there's a determination of who will be the trustee of that trust. So we'll talk about that on Thursday. That trust can have spendthrift provisions. So if a child gets sued, no one can take their interest in the trust. If that child gets divorced, they'll keep their trust. That trust will prevent the child from mixing up or commingling those gifted assets with other assets that the child may have with the spouse. So if you're looking for preserving assets long-term for the family, it's much more likely those assets will stay preserved by transferring those assets to a trust for your children rather than transferring assets to your children directly. The whole Crummey trust piece, I'm going to touch on it real quick now, but I used some words about 10 minutes ago, present interest annual exclusion. This is a quick explanation, more on Thursday. You can, our gift and estate tax laws say you can donate $16,000 to as many people as you want to every year, and you don't use any of your estate tax exemption. That rule is called the present interest annual exclusion. But by giving $16,000, writing a check or giving it to them out of PayPal, Natalie, you're giving them a present interest in that money. They can take that money and go do what they want to with it, as opposed to putting it in a trust for them to get it much later. That's not giving them a present interest to the money. That's giving them a future interest in the money. So the $16,000 rule only applies if you give them a present interest. So the Crummey trust, Crummey, Crummey, comes from a court case from many, many years ago, says when you put it in trust for them, you give them 30 days within which they can take the gift. If they don't take the gift, it stays in the trust and it's locked in there pursuant to all of the trust terms. Children never exercise their Crummey rights, because if they do, they'll never get another donation again in their lifetime. So it's a formality. More on that Thursday. Okay, so hey, Frank from California. Okay, so what we're talking about, it's a long-term play. It's a little sliver at a time play. It's over time, you're able to take a big chunk of your estate that would be subject to a 40% tax and move it outside of your estate. And then potentially now you've got a pool of family funds that's not subject to you or your children's creditor claims. If your children are in a lower income tax bracket from you, the income that those assets produce will pay income tax will be less. And I think another significant benefit is you can create an opportunity where you see your children benefit from those gifts during your lifetime. Your children don't have to wait until you die to start benefiting from a transferring of legacy from one generation to the next. I think there's something to be said for that. All right. Hey, JC made a $1.99 donation. I didn't even know you could do that. Boy, that is JC. Thomas, you are the watcher of the day, watcher of the month. So thank you for so much. I did note that, and that's kind of you, JC. When I do get into discussing some charitable issues, I do know that I can do these YouTube lives, and we can all support a charitable cause that I bring up, and you can do that during the presentation. That's really nice. All right. So there you have it. I think if you've been listening to this, and we got a bunch of good questions coming in, the idea is don't wait until it's too late. If you wait until you have, quote unquote, too much, then you're not going to be able to give it away fast enough. Your estate will just, while you may start to build a fund outside of the estate, if you wait too late, even with a little bit of gifting, that little sliver that you do every year, your inside of the estate assets will grow and grow and grow. So when you get to that point where you feel like, you know what, I have enough to live off of for the rest of my lifetime. I realize there's going to be a 40% hit when I die. There's a lot of good reasons where I can just take a sliver of what I have every year and move it out of my estate into trusts and get all these other benefits as well. So that's the point behind this YouTube live presentation. Why does an inherited IRA get fully federally income taxed at distribution? Good question, Matthew Gallagher. You know, when you're alive and you're contributing to your 401k or your IRA, the income tax, gets deferred on that. That's the beauty of the IRA. The blessing of the IRA is you don't pay income tax on that money as it goes into the IRA. But the curse of the IRA, the 401k, the traditional IRA, is that whenever those funds come out of the IRA, whether you take them as a distribution or whether your beneficiaries take them out of their inherited IRA, they're going to be subject to income tax. So your answer, Matthew, why does an inherited IRA get fully federally income taxed at distribution? It's because Congress says so. I realize that doesn't make a lot of sense, particularly when you realize that other investments that you have get the step up in basis, but it is what it is. Okay, so JC, I have filed a small estate affidavit. If another person doesn't give, and this is my donor here, if another person doesn't give up the property I have come to collect, what happens then? So if another person doesn't give up the property that I have come, so maybe another person has assets of the deceased, then the small estate affidavit may not work. You may have to get yourself appointed as the administrator and executor or an executor of that estate. So you go after that person who doesn't give up the property, if that's what you're referring to. I'm hoping that helps, JC Thomas. Thank you. So one way to my heart is, and make sure your question gets asked, is do what JC did. But that's not what this is about. What if the children are past the age of distribution, 35 in our case? Well, sounds like what you've done is you left some things in trust. Either you did it during your lifetime and into some gifting trusts, or you said when you pass away, things go to your kids when they're 35, but now they're older than 35. And so to me, I'm like, well, they just get it when you pass away, if that's the case. All right. Can I name my son M-SS? Hello from Florida, one of my favorite states. Can I name my son as an independent trustee in my trust? Sure. There's nothing that prohibits you from naming a son, a daughter, a mother, or a father, or as long as they meet the typical requirements of a trustee. There's no prohibition of naming a son or a relative as a trustee. David W. Thomas is exercising his Crummey trust skills. Sorry, I just got here. I appreciate you doing this live. Thank you, JC Thomas, again. Araya, can you speak briefly on getting a stepped up basis on the transfer of real property to avoid capital gains tax? Do you have a video on this? I'm sure I do. Probably want to search my channel's YouTube videos for step up in basis. So yes, if you own real estate, I'm not going to talk about the home right now because there's some special tax rules for homes. If you buy a home and then you sell it years later and you have some gain, the first $250,000 of gain is exempt from capital gains tax. If you're married, the first $500,000. Now let's talk about non-home property, rental real estate, commercial property, land. Yes, if you bought a piece of or a home, a rental home for $150,000, and then it grows in value to $400,000. By the time you pass away, you die, it's worth $400,000. You never sold it while you were alive, so you never incurred that capital gain. When you sell it, that basis, which was, let's call it $150,000 when you passed away, gets stepped up to $400,000. Now, if your heirs sell that property, they'll only pay capital gains tax on what they receive in excess of the $400,000 stepped up basis. All right, JC, sounds like you got a story there. I may come back to that. Let me hit it. My father passed away and his wife has taken everything. No will. She let her meth-addicted children, sounds like that's a sore spot, take what they wanted and hid some vehicles as a state. Yeah, that's just a tough situation. There's just, I've seen and been involved in some of those messy estates. I don't like to get involved in them, and I don't get involved in them anymore because, quite frankly, nobody ever wins. Nobody's ever happy at the end once that gets resolved. Lots of courts and lawyers and hearings and all that. Texas lady, we want to divide up farmland. My spouse is not doing too well. Should we go ahead and divide the land now among the children? Yeah, a lot of factors there. Is there a gain? I don't know that there's immediate thoughts going through my mind. No harm in dividing up the farmland. Let's see. My spouse, is this your spouse's family? Sounds like it is. Sounds like maybe if it's a difficult thing for your spouse to go to. Just a lot of circumstances there. Good question. How about changing a family real estate partnership percentages? How about it? Not really sure what you're asking there. You're welcome, JC. Natalie, what if the wife trustee sells the home to herself and puts it in her trust? So some of those kind of self-dealing things, you actually have to look at the trust instrument. Sometimes trustees are permitted to buy and sell assets within a trust over which they are the trustee. That's the first place I'd look, is what does either the trust instrument, or if it's not addressed in the trust instrument, what does the state's trust law or trust code provide for that? Thanks. It refers to a person not related to independent, meaning not a family member. Okay. Yep. That goes back to another question. Anyway, all good stuff. Okay. So like keeping these to 30 minutes. I'll be on tomorrow. Tomorrow, we're going in a different direction. Where today was really for the wealthier folks, tomorrow is for the kind of middle class. Those people who worry that if they go into a nursing home, they're going to lose all their bank account money, their investments, and potentially even lose their home due to those nursing home costs. Talking about the 5-year Medicaid look back rule. I think there was a question today about Medicare tomorrow. Give me some final comments in the chat. A lot of good stuff. It looks like last week's views, we've had about 14,000 views of the 5 estate planning live presentations. Keep it up. Tell your neighbors, tell your friends. We'll see you tomorrow. Y'all take care. Bye-bye now.